Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only, doesn't take your personal situation into account. With all that said, let's get into our first chart. And I've got the SP 500 up on the screen. And this has been an extraordinary couple of weeks. So 2 weeks ago, it was all about recession fears. They were front and center. Many people were bracing for what they thought was going to be an ongoing free fall in the markets. Now, fast forward, bring that forward a couple of weeks to today, and the focus has shifted to improving inflation as well as some good retail sales data. So a significant shift in that short period of time. So could it all be over? Could this decline and rebound, could that sequence now be done with? And have we cycled from significant fear to up and away again in just a few days? So I want to go through a few charts, just try and put some perspective around where we are with this price action. I also want to talk about some of the scenarios to be aware of as we move into the next few weeks, into the next month or so. So what we have so far we have the sharp sell-off and the equally or almost equally sharp recovery. So that's the V-shape. You've got that classic V-shape recovery. We typically get these when there's strong underlying interest in buying the dip. Often they do occur after a fear-induced sell-off, and which has been overdone, and then buying the dip comes back, forcefully pushes the market back up. Prices have also broken back above this resistance area that comes in at around 5,400. Just zooming in on that a little bit, you can see there was a gap in the price action in June. That often works as support resistance. Some low points during July, and the market has just breezed through that. It's very quickly and easily sliced through that resistance. I think that combining that with the strength of the rally, I think what that does, I think it disengages the sell cycle that people were so fearful of just a few days earlier. The risk was, as prices were down below the moving averages, the risk was that we got a lackluster rally back to maybe the 100-day moving average. Prices stalled, supply came in, capped the rally. And this is often when a market starts to consolidate. We get that consolidation below the moving averages. And this is when the structure can shift from buy the dips to sell the rallies. I think that the fact that the rally we've had has been so strong, I think it's further evidence that the overall structure remains bullish. We haven't had that structure shift from bullish to bearish. So looking at where prices are now, they're not that far from a new all-time high. So should we be looking at the likelihood of an all-time high in the near term? I spent a bit of time just going back through the data, looking at how these things have played out in the past. It's actually a rare event for the S&P 500 to go from an all-time high to a 10% pullback within a few days, and then on the first rebound, make its way back to a new high. In the last 30 years, I've only found one instance of that happening. And I'll show you when that was. It was back in 2014. So if we go back a bit to 2014, you'll see the sort of price action which we rarely see. All-time high, quick 10% or so decline, snapback, V-shaped recovery, which goes without pausing up to a new all-time high. It's could that happen again? Well, of course, anything could happen. We can never rule anything out, but I'm not sure that's a situation we're going to see repeat now. I'll show you why in a moment. What I think is more likely, I think a more likely scenario could be something like this 2018 example, where the market went, again, all-time high, panic sell-off, quick rebound, but then after the rebound, there was still some back and forth, some sideways chop while the market stabilized and then ultimately moved higher a month or two later. But there was consolidation before we got to new all-time highs. I think that's probably the more likely scenario to look out for now. And should that happen, well, that probably means there's the possibility that there's more volatility in the near term as prices possibly do pull back towards, maybe not to retest the lows, but back towards lower levels at any rate. Uh, let's just jump back to current day. A couple of reasons. I'll tell you, there's a couple of reasons why I favour that we do move into some sort of a consolidation. So the first one being is that, well, one is that we rarely see markets snap straight back to new all-time high. So it's got history against it. And another thing which I've been looking at, I put an RSI. So let me put an RSI on this chart. So RSI, a relative strength index, and it's interesting when we do this. So let's just consider that the market were just over the next week, quickly make its way, continue this rate of advance and make its way up to a new all-time high. Look where the RSI currently is. It hasn't even made its way halfway back to where it previously was. I think if the S&P 500 were to quickly make a new all-time high, I don't think we'd get confirmation from the RSI, and that would set up a potential situation where you got divergence, where you got the market making new highs, but the RSI not confirming it. And then should you get that, well, then that sets up a potential for, well, that's a higher risk setting when you do see divergence in price action. We aren't there yet. Maybe that doesn't happen. We can address that if it does. But I think it's one of the reasons why I think there's a reasonable chance the market does lose some of this momentum as it approaches the high and does come back within the range. We don't know. I think that though is probably what the odds favour. I'll tell you how I think we play this in a moment. But first of all, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Just tells YouTube you're watching. YouTube shows other people. So that helps me heaps. So please do that. And hit that subscribe button if you haven't already done so. Now, one more chart for you. It is the small caps, the Russell 2000. And I think this is another reason why the odds favour an ongoing consolidation. So lots of technical damage has been done here in the last few weeks. So we had a situation where we had a 9-month consolidation, prices broke higher, were looking good, but then completely collapsed back down within the range. False break. That leaves us with a false break and a lot of technical damage. And technical damage typically takes time to repair. And also remember that healthy bull markets will generally have broad participation. It's hard to see how the small caps in the way the price action is currently set up, it's hard to see them in the near term participating in a broad rally. I bought a position on the breakout. Prices broke out. I like to buy breakouts. I like to buy markets or stocks that are rallying off moving averages, but we know they don't always work, and that's what we use risk management for. So bought the breakout, went with the momentum, initially looking good, but then it failed. I actually sold that position on Thursday into the rebound. I didn't take the panic lows, work on the basis that prices will often move back towards those averages, and use that as an opportunity to close that risk out. I just don't think it's time. This is a significant false break. I don't think we can just ignore it and fade it away. We've got to accept that it's there and go, this market just might need more time to consolidate. Overall, coming back to the S&P 500, I think the default position should be in favour of the incumbent trend, which has been in place for quite some time now. It remains up. Nothing's happened or nothing's changed in the last few weeks to change that. We still have rising moving averages and a market which is mostly, with the exception of a few days, above these moving averages. It remains a bullish setup. Dips are being continued to be bought. Nothing here has ordered from that perspective. And I think this remains the case. I think this default position remains bullish until we have clear evidence to the contrary, which we just do not have at this point. For me, it's a case of using those wide trailing stops to stay in positions, try to see off pullbacks. I also trim my exposure a little bit into this rebound. With the benefit of hindsight, maybe I could have held on to a few stocks that I closed out. But of course, that's hindsight. We have to manage our risk in real time, not looking backwards. And I still think some modest de-risking was and probably still is appropriate, given the potential for more consolidation to play out. So look, let's call that a wrap for this week. Hopefully that's been interesting. Hopefully you've got some ideas from that. I look forward to coming back and talking to you again next week. Until then, bye for now.